2024 has been a good year for most investment markets, and our funds have delivered healthy returns. To try and help explain why we've enjoyed this strong performance over the year, I'll aim to cover a few key topics. First of all, we'll look at the key economic drivers over the past 12 months, how we position the fund to navigate through those conditions, the performance of your fund, and finally the outlook for the economy, markets and our fund in 2025. So let's start by looking back on the economic themes that drove investment returns over the last year. Economic growth proved to be pretty resilient over the year, holding up well in the face of high cost of living and interest rate pressures. This provided a reasonable economic backdrop for shares and other high growth assets to perform well. Inflation remained one of the most talked about and important topics over the year. Inflationary pressures have been a big focus for markets really over the last 3 to 4 years. If we think back to when high inflation first re-emerged during the COVID period after a 40-year dormancy, many economists expected higher prices to be transitory and that inflationary pressures would pass fairly quickly once COVID cleared up and our supply chains returned to normal. Now, while inflation has eased back from very high levels, the pace of decline has slowed and Australian households continue to feel the pinch through higher living costs. So inflation in Australia has remained a bit higher than central banks are comfortable with, and this has kept interest rates higher for longer as the RBA works to push inflation rates back down. The most recent reading of Australian inflation was the December CPI data, showing price increases of 2.4% for the year. Now, while that places inflation within the Reserve Bank's target range of 2 to 3%, this will likely turn out to be a temporarily low level, driven down by electricity price rebates introduced earlier in 2024. And this is one reason why the RBA has been reluctant to cut official cash rates to date. Now, the US appears a little further advanced than Australia in its fight against inflation. The rate of inflation there has fallen more rapidly, allowing the Federal Reserve to make 3 cuts to their official cash rates over late 2024 and signal further modest cuts if inflation continues to behave. So overall, we expect inflation to moderate a little further over the next 6 to 12 months, but we think central banks may remain a little wary of inflation pressures persisting, and we may find the number of future cash rate cuts is less than many hope for. Now, a few unknowns around the direction of inflation have cropped up following President Trump's re-election to office, and we'll touch on these later in our Outlook section. So what does all this mean for you, our members? Well, as I mentioned earlier, even in the face of higher for longer inflation, the global economy has been pretty resilient. With this reasonably positive economic backdrop, we've seen share markets continue to deliver good returns. The rollout of AI and its potential applications has investors pretty excited, and we've seen stocks that are linked to these themes perform very well. This helped international share markets deliver exceptional returns of around 27% over the year, which boosted returns in our diversified funds that invest in global shares. In addition to strong share markets, more defensive parts of our portfolio have also delivered healthy returns. Investment in fixed interest assets, which includes government bonds and corporate credit, delivered returns of around 5 to 6%. Now, while not as strong as shares, this level of return is considered healthy for these more defensive parts of our portfolio. In addition to markets being strong, we've also made several enhancements to the fund as part of our strategy to grow your savings. The fund is really enjoying the benefits of scale through the acquisitions that we've been making in recent years. We've been able to build a really experienced investment team working on the fund. Our investment team, comprising over 45 people, is now managing $152 billion on behalf of members across the Insignia Financial Group. And that's helped us build a stronger negotiating position with investment managers we use and access even more sophisticated opportunities from around the globe, all with the aim of improving diversification and long-term returns of your fund. We're pleased to share that this has contributed to a return of 11.3% for the MLC MySuper Growth portfolio for the year ending December 2024. This return is net of investment management fees and tax and before administration fees. As our default investment option, this is where many of you are invested. This return is healthy when compared to other super funds. If we look at the Super Ratings SR50 MySuper survey, which captures 45 prominent MySuper funds in Australia, the MLC MySuper Growth Fund return of 11.3% comfortably outperformed the median or average fund return in the survey of 11.12%. More importantly, over longer 3 and 5 year periods, the MLC MySuper Growth Fund is in the top quartile of fund performers and is in the top 5 performing funds over 5 years. This demonstrates the strength of our approach, leveraging scale, expertise and collaboration to deliver tangible benefits for our members. We remain committed to ensuring your retirement savings are managed with care, insight and a focus on long-term growth. So 2024 has been a strong year for returns. How do the prospects for 2025 look? The investment team constantly monitor investment markets, adhering to a well-established process to assess market conditions and outlook. Right now, our outlook for the year ahead is mildly positive, albeit with a few unknowns that could pose some risks. When it comes to the economy, our base case expectation is for a gentle expansion in the all-important US economy and for inflation to moderate a little further, allowing central banks to modestly lower cash rates. Given this supportive economic outlook, what might we expect to see from investment markets? Well, if we start with the share markets, which were a big driver of fund returns last year, the healthy economic growth we expect, coupled with further cuts to cash rates, is generally a good environment for shares. Now, while this economic backdrop is supportive for shares, share prices have already risen sharply over the past year, and much of the good news about the economy and corporate earnings is already priced in, as we say. This just means share markets generally look expensive compared to history, and this tempers our outlook for share market returns in the year ahead. All in all, we're relatively neutral on shares, expecting modest positive returns, but unfortunately, we don't expect to see a repeat of the stellar returns of last year. Now, if we turn to the more defensive holdings in our portfolio and think about the outlook for bonds and fixed interest investments, here the outlook is even more dependent on the direction of inflation going forward. The rate of interest received on bonds and credit securities has risen significantly with the onset of inflation, and income generated from these defensive assets is far more attractive than it was 4 years ago. Just as an example, the yield on a 10-year US government bond at the end of December was around 4.55%, compared to a yield of only 0.9% on the same bond 4 years ago. Now, there's a risk interest rates and yields could go higher, but we see the level of income received from these fixed interest assets as reasonably attractive. In addition to the better returns, if inflation continues to behave, our fixed interest holdings could provide improved diversification benefits to our fund. Now, as with any outlook, events can crop up that cause a change of view, and the team is constantly assessing and monitoring these. Now, I mentioned President Trump earlier. There's some uncertainty about what his second term will mean economically. The share market has initially reacted positively to his win and enjoyed a Trump bump on the prospect of his government extending lower tax rates and pursuing a more business-friendly deregulation agenda. On the flip side, a number of President Trump's other campaign promises may pose a risk to our outlook. His touted trade policy, which threatens to impose hefty tariff increases on key trade partners, like 60% tariffs on China, and drastically reducing the level of illegal immigrants in the United States, are potentially inflationary and may ultimately crimp growth. Another factor which could influence returns next year is China and what policies are announced to stimulate growth in its large economy. In November, China announced a $2.1 trillion Australian dollar stimulus package to give its sluggish economy a boost. Now, that's a lot of money and probably signals that China is willing to start spending again to boost its economy, but it appears more is needed to convince investors of a sustained pickup in the Chinese economy. So as always, the future is never certain, but no matter what happens, we're keeping a sharp eye on things, and our investment team are more than capable of managing your money through any ups and downs that 2025 may bring. So in closing, I'd really like to thank you all for listening today, and more importantly, for trusting us to invest your money. Super is a long-term investment, and for most Australians, we know it's often one of the biggest assets they'll own, so it's a real privilege to have your trust. Our investment team works hard to generate the competitive returns we delivered in 2024 and manage your portfolio in line with our investment philosophy to help give you the life you want in retirement. Every year in markets is different, and just as surely as there'll be years like this where we deliver strong returns for our members, there will no doubt be tougher periods ahead too. Regardless, I'm confident our team and our approach will continue to work on your behalf, no matter what the market conditions, to deliver the strongest results we can for our members over the long run. Thank you once more for your time.